Tonight, I want to give value. I'm going to walk through real down payment assistance questions I get from LOs all of the time. I'll read them out loud, answer them, and if any LO wants to jump in on a call or real scenario, we can break it down live. My phone number is 661-305-7981. Go ahead and give a call in right now if you do have any questions. This live is for supporting LOs and also to offer mentorship. You can see there on the right side that we have a mentorship program partnership with Skool. And if you're interested in that, please let me know. Question number one, what actually qualifies as down payment assistance loan? Down payment assistance is typically a subordination loan, a subordinate loan, or a grant that helps cover down payment and sometimes closing costs. Most programs are either um, deferred payment seconds, forgivable loans, or low interest seconds. Sometimes they have like a deferred interest, or sorry, not a deferred, but a simple interest attached to them. Sometimes they're at 2% higher depending on which lender you use. And if you're not working with a direct lender, it's so much harder to get a DPA that is very how do I say it? Competitive into the marketplace. And I believe that's something that we do really well here at West Shores and something that I would love to help other people offer as well. They're not free money, but when structured correctly, they're incredibly powerful to buyers who can afford the payment, but not upfront cash. But not upfront, not up the upfront cash. If anyone has a borrower right now that's struggling to close, this is where DPA changes the game. Question number two is, what is CalHAFA and how does it work? CalHAFA is a state-run program, and if you're not in California, this isn't going to pertain to you, but if you are in California, CalHAFA is a major source to home affordability and essentially down payment assistance support. They also do offer loans that don't have LLPP attached to condominiums, but that is for a more tactical pro LO play when interest rates are higher than what CalHAFA is offering for condominiums. So CalHAFA is a state-run program for first-time home buyers using approved loan products. The products that they use is Fannie Mae, and they also use FHA, Federal Housing Administration home loans as well. Programs like My Access or My Home typically require repayment when the home is sold, refinanced, or paid off. It's great, but it comes with stricter guidelines, income limits, and buyer education requirements. I would only consider this type of loan if you are running into someone who has a higher credit score. And the reason why I say a higher credit score is because when you're dealing with someone with a 700 FICO or higher, they allow these programs to go at a 45% front end ratio, but then a back end ratio at 50%. Even on conventional, it is capped out at 50% for FHA. But if you get DU or LPA approval, they can go up higher than that 45% front end ratio, I believe. So it's better in a sense to get an FHA loan through CalHAFA because you'll end up getting more forgiveness on the interest rate. The interest rates are lower, close to like a quarter or a 0.5% lower than what you would get on a conventional loan if you're going for maximum down payment assistance. And it's something that I tend to support my clients with. I live in Los Angeles County. We are here in the South Bay. So these programs typically don't work for these areas as well as they do for, let's say, Riverside, Lancaster, Palmdale area, and Rosemont going forward, where the loan amounts are around 400,000 or lower. They really do support people in that area. Not to say that we couldn't do a loan over here with down payment assistance, let's say for a condo or yeah, like let's say for a condo or so, but just understand that the loan limits there is what's going to cap you out for CalHFA. So CalHFA is where LOs shine, lose deals, and because these details matter, it's important for us to be able to structure a loan that CalHFA is going to like, and then close on, in time with the allotted 30 days. Now, at West Shores Financial, because we specialize in down payment assistance programs and other programs as well, um, we can do how do I say it? We could do agency loans, or rather, we can do amazing speed with normal conventional loans. Those typically take anywhere from 20 days or less, depending on how fast we're moving. If it's a condo, then it tends to vary on how the association deals with the purchase. But other than that, we're super extremely competitive with normal loans. With down payment assistance programs, you typically run into a 45 to a 60-day kind of escrow. And that's typically what's expressed in all of the home buyers educations that you are required to take. But here at West Shores Financial, we're fairly confident to get these done in 30 days. So once the loan file is complete, it's sent off to CalHFA to approve, and then it comes back typically within 24 to 48 hours on that second set of underwriting. Again, that is something that we are fairly comfortable completing in a matter of time, and we have corporate partners that are so close and integrated with the CalHFA program that they specialize in closing these loans fast. So 30 days or less for a CalHFA if you're ever looking for something like that. I'm going to move on from CalHFA and GSFA, which is also an amazing product and an amazing program. It's typically only for direct lenders. So most brokers don't have connection to this. We do by having a direct lender. We have a direct lender corporate partner who is looking to help us out with that broker channel and allow us to originate these loans and pass them to them so that they can offer these. But what is the GSFA down payment assistance? GSFA down payment assistance is very different from CalHFA. It is called the Golden State Finance Authority. Yes, GSFA is very different. GSFA programs often allow forgivable assistance, sometimes over 3 to 5 years, and can be paired with FHA, VA, or conventional loans. Income limits and pricing can be more flexible in CalHFA, but the assistance usually comes with slightly higher rate. If you don't know how to compare CalHFA versus GSFA, you're leaving approvals and realtors' trust on the table. So with the GSFA Platinum program, for example, we have a standard, assisted loan, and the select. They can come up to 5% down payment assistance programs, which is kind of amazing because it allows you to not only make your down payment, but also some of the closing costs. And if your realtor is able to negotiate, let's say, some closing costs in the negotiations of the contract, you're able to get little to no money out of pocket to complete and purchase a home. What you're expected to pay, and something that I always love to disclose, or rather I choose to disclose to people who are looking for down payment assistance programs, is that you are going to be, encouraged to make your home inspection payment. So you're going to be encouraged to do a home inspection because that protects you as a buyer. Is it necessary? No. But is it something that you definitely want to know about? Yes. And we always will encourage buyers to do that. Now, the second part to that is that you're definitely going to have to pay the appraisal, which is out of your pocket. Now, those two inspections are going to be completed. One of them protects you, and the other one protects the bank, right? Because they want to know what the valuation is for the product that they're purchasing, or sorry, for the product that they're lending on. So if the value comes in well, then they'll lend to that. If it comes in higher, then they'll lend to the terms that you are negotiating with the seller on. If it comes in lower, then it all depends on how much money you're coming in with that allows you to go forward with the loan. So for example, if you're making just your minimum 5% down payment for a conventional loan, or if you're a first-time home buyer and you get that 3% down payment, if the value of the property comes in 3% lower, then you're going to have to put in 3% more down payment assistance. So essentially, it wouldn't support you in the down payment assistance program unless you're able to negotiate for a lower value on the home. And that is typically something that the sellers that come to understand that either that or they end up moving on, and you get your deposit back, and the contingencies are there to protect you. So with GSFA Platinum program, you're given options on how much the assistance is giving you. So for example, I believe today's rate, if this is today's rate, is looking at 6% for a standard FHA. Okay, so if you got a standard FHA at 6%, they'll give you not only your first mortgage at 6% interest rate, but also a second mortgage for 3.5% of the down payment at 6%. This is amazing. This is something that other lenders are unable to do. People like Orion Lending or SunWest Mortgage Company, or anyone who offers these type of programs that come from, or these funds that come from the National Home Buyers Fund. Everyone kind of packages up what these funds come from when it's the IRS supporting this. The National Home Buyers Fund Incorporated comes from funds from the IRS. It's always going to be there for buyers, and this is for all over California. So other states package it differently. Our state has this finance authority that matches the first interest rate. If you were to get a loan from, let's say, Orion or SunWest Mortgage Corporation, other lenders out there, they would add 2% to the first interest rate. So if they were offering an FHA, which they're not, but if they were offering an FHA down payment assistance program, second loan at 15 years, the amortization, they would give you that 6% interest rate, but then they would add 2% to that for the second. And so that 3.5% interest rate would actually be an 8% interest rate. This GSFA Platinum program is amazing in that sense that it matches the interest rate of the first. It doesn't go higher. Is it better than having a My Access loan? In my opinion, it's not with CalHFA. CalHFA has just a simple interest rate attached to that. Let's just go ahead and complete this GSFA Platinum program. So if you get that 6% with the GSFA Platinum program, and you get the second on that, you get 3.5% that allows you to pay your down payment assistance program, your down payment, and then you have your closing costs to come in with. That's what this program is given to do. Now, we also have a second that goes up to 5% for down payment assistance programs that is associated with the GSFA. So how they're pricing that out is at 6.625 today. So you would get a second at 5%, or a second at 6.625%, but it also gives 5% down payment assistance. What does that mean? It means that it'll not only do your down payment assistance, or rather, it'll not only do your down payment, but it will also pay 1.5% of the closing costs, thus allowing you to come in with less money out of pocket. Now, if you're able to, let's say, make right around 2% or 1% in closing costs, or you find a seller who is willing to do that, negotiate with you and give you 2%, 1%, you're coming in with much less money down or to close. and able to purchase a home with little to no money pocket. Now, has this happened to me? My last My Access home, they only came in with $500. That's it. It's very possible to have somebody come in with a down payment assistance program and close this loan with zero to no money out of pocket. And oftentimes, if you get even things like a California Dream for All, you might even get your return deposit and your return on the appraisal, which I just previously did for the CalHFA Dream for All program that we just got last month. Okay, now with this GSFA Platinum program, they also offer gifts to first responders, doctors, police officers, these type of things. We really want to be able to give them, the people that really do support our community in loans and access to cheaper loans and affordability. And what do I mean by a gift? If you were to, let's say, go with that 6.625%, looking for the 5% down payment assistance, they will give you a 3.5% loan at 0% interest rate. Okay, it's a deferred payment. You are not going to be making that payment on there, and you're not going to be charged the interest rate. That's great for first-time home buyers because you're only going to pay your 6.625, which is far more competitive than, like, let's say Orion or Sun. And I keep throwing that. I don't mean to throw them under the bus, but essentially it's far more competitive than all these other lenders who are raising the interest rate by 2% of the first interest rate, right? So 6.625, if they happen to be a police officer, fireman, a teacher, a nurse, then they can get offered this program where they're at 6.625. They get 3.5% down payment assistance. They don't have to make a payment, or they don't have to make a payment on that. And then they also get 1.5% of the closing cost as a gift to them. Okay, so it's allotting people, man, so much opportunity if you happen to be in one of these jobs. Okay, now let's see, moving on to what we have. Down payment assistance programs do have income limits. Do they have income limits? Most do, but not all income limits are created equal. Some programs cap household income, others cap borrower income, and some scale limits by county. One of the biggest mistakes LOs make is assuming the borrower is over income without checking the exact program rules. Now, this is something that is always going to be this is always something that's going to be always changing from county to county, from location to location. For example, I believe in Oakland, the income limits for CalHFA are like 336,000 a year. And then over here in the South Bay, I believe it's right around 224 or so with these income limits. So it's something that you definitely want to be aware of. It's something that your AE would be able to explain to you, your account, what do you call it? Your account executive in your lender that would be able to, let you know about these kind of things. It's fairly easy to find this stuff out in ChatGPT. So if you do use AI in any way, they will be able to say, how much does this county get for CalHFA as far as income limits go, and then it'll spit it out for you. Can DPA use be more than once? In most cases, DPAs can't be used more than once, but with the GSFA, you are allowed to do it if you're not a first-time home buyer. If you're not a first-time home buyer, then you typically, I don't believe that they will offer it to you if you currently own another home. But if you have sold your other home and you're looking for down payment assistance programs, we do have those programs here at West Shores, and it's something that you can take advantage of. Okay, I'm going to take a quick break and explain a little bit of what we got going here at Mortgage Master. So welcome to Mortgage Master. This is a live for mortgage loan professionals who feel stuck, burnt out, or know that they're capable of doing more without having any real mentorship. If you have ever struggled with inconsistent leads, knowing how to confidently approach realtors feeling capped out at your current shop, or just closing loans without actually building a business, you're not alone. I see LOs every week asking the same questions. How do I grow consistently? Should I switch to a broker model? Why am I busy but not profitable? How do I stand out when every LO sounds the same? Mortgage Masters exists to solve that. Now, first, there's two ways you can get mentorship with me. The first is you could join my brokerage. This is for the LOs who want full support, real pricing advantages, accountability, and to build a long-term team. Whether you're experienced or eager to learn, we're actively hiring LOs who are coachable and hungry. Second, you can join my Mortgage Masters Mentorship program here on Skool. This is for LOs who want to meet weekly, who want weekly membership. Who wants weekly mentorship or joining my brokerage, comment broker. If you want mentorship through Skool, comment Skool or sign up right here. Either way, you don't have to build this alone anymore. Follow Mortgage Master. We're just getting started. Okay, back to question 6. DPAs. Can DPAs be used with FHA, VA, or conventional loans? Yes, but not universally. Some loans are FHA only. Some allow VA with huge advantages. Some work with conventional loans but cap LTVs or pricing. The real skill is knowing which DPA pairs with the best loan type, not just knowing the program exists. Now, you're going to find a lot of LOs that will talk about the California Dream for All, for example, and then have never completed one. Or will talk a big game and have never closed on that game that they're talking about. Not here at West Shores Financial. We're able to say something and do it. These are something that we're fairly comfortable with, not only just normal loans or jumbo loans or investor loans. We are very comfortable with down payment assistance loans. We can do the hard, we can complete the hard, we can do what we set out for when it comes to the borrower's needs and our realtor's needs. Our number one is our realtor. Always, we want to make sure that we close what we promise, close what they are expecting on. We don't over promise and under disclose. We always give good expectations so that way people understand what is going to be ahead of them. This is something that we practice, not just preach. Okay, so when you hear a bunch of people talk about, oh, the California Dream for All is coming, we close those loans. Okay, so this is something that we feel fairly confident, and when we speak on it and we offer it, we give the right mentorship to achieve these type of assistances. The California Dream for All is coming back, and it's something that you should be aware of. It's something that I believe that you should get around 10 of your friends to sign up for, because you will change their life. You will make it more affordable. There hasn't been one person that I've helped with the California Dream for All that hasn't been super appreciative, that have been able to purchase a home that they've been priced out of years ago. Okay, I'll get into the California Dream for All a little bit more, but it is something that you definitely want to know about. Now, a little bit about this question. The VA is 100% financing, and it's a great loan because you don't have PMI or MPI, which is mortgage. What do you call it? A mortgage insurance. You won't have mortgage insurance when you've served for the military and you get your certification of eligibility, and you can apply for a loan and get something that will give you amazing access to purchase a home. The VA loan has not only low rates, but doesn't have mortgage insurance, and you can get it at 100% of the financing. So what does that mean? That means that you're coming in with closing costs, and that's it to complete, right? So you have your escrow closing costs, you have your appraisal closing costs, you have your title closing costs, as well as the lender's closing costs. But they typically will keep those lender costs pretty low for veterans. If it's a borrower paid, they can only charge 1%. And if it's lender paid, you're not going to see any charges on that. If you're a loan officer, you would know what that is. If you're not a loan officer watching right now, if you have any questions about that, please reach out to me. Question number 7. What's the biggest mistake LOs make with down payment assistance? The biggest mistake is not lending with a strategy. Too many LOs treat DPAs like it's a last resort instead of a structured resolution. The best LOs explain the trade-offs clearly: rate, payment, long-term eligibility, and let the borrower decide, okay? This is how you win realtors for life. This is how you win customers for life. When they said, I could never buy a home without meeting you, it is one of the most best feelings I've ever felt in my life, okay? Somebody coming into a realtor shop saying, look, I'm looking to lease a property or lease an apartment, and then they end up leaving with the opportunity to purchase a home for their own and change their family's lives forever. I want you to experience that. I experienced that, and I just want to keep it going. So down payment assistance programs, they have to be structured correctly. They have to be not a second or a last structured solution, not a second or a last strategy. You have to lead with the strategy. What do I mean by that? Typically, there's two of the biggest hurdles in purchasing is credit and cash flow. Collateral and cash flow. Collateral and cash flow. There's 3 C's in lending, and that's credit, cash flow, and collateral. Okay, that's something that you'll always have to worry about as a lender, because it's something how we lend. It's how anyone lends, actually. I challenge you to even see if you lend this way. But credit is knowing somebody's history and if they make their bills on time. Cash flow is, do you get how much do you make? Does your business make money? Are you getting SSI insurance? Are you getting separate maintenance from a previous marriage? Are you getting child support? Any of this, if it's green, it qualifies. As long as it's ongoing for 3 years, we can use that income to qualify. We do not discriminate. Okay, so that is one of the challenges, because if they don't make enough, it's harder to just automatically show more money, show more income to qualify, right? And if you do have credit problems, it's a lot easier to overcome those issues than, let's say, not having a large enough down payment. So when you have 2 out of the 3 C's, it's so much easier to overcome that kind of stuff. Like if you have bad credit, but you have the collateral and the income, more than likely we can find a loan for you. If you have the collateral and the credit score, there's something that you qualify for, right? It might not be in the right area for you, but it's something that you qualify for, and we can find you the area. If you have all 3, then choose what you want. Maybe that's hard for you, but choose what you want. Let me go ahead and hide that for next time. So if you're looking for a down payment assistance avatar, or rather you're seeing someone who requires the down payment, or you're preparing for somebody who comes into your office and you know that they don't have the down payment, but they make good income and they have good credit, then you'll be able to offer things like a GSFA loan, a CalHFA loan, which I am huge and fond of, or a grant that may come into your city. I was the first one to do the Green Line Housing Project grant. It was a $35,000 grant that allowed people to use it for down payment and closing cost assistance. And literally, my borrower came in with nothing down. he got 15,000 in closing cost assistance as well. So we maximized his down payment for his home loan. So he ended that transaction with equity and not having to come in with any money down. So it was a win-win on that. If you do have any grants or any questions on how to get grants in your area, please comment grant below and I'll reach out to you and say, hey, what type of grant are you looking for? What's the area you're looking for? But when it comes down to grants, you want to be able to look at community. And what I mean by community is that you want to be able to look at your city, your county, then your state. Those are the three areas that will offer funds to close. And it's very often that you're going to find that grants are county situated. Sometimes your city will give down payment assistance programs. Just understand that when you're dealing with grants or when you're dealing with these type of, how do I say, programs, you're looking at funds that run out. It's first come, first serve. And if they've already used up all of their money for that program, unfortunately, you're not going to be able to get access to those loans. Sometimes it's a lottery system. And if it's a lottery system, you might not win. So that is just how grants are typically run. They are with funds that come from either a different program that didn't complete. Like, for example, the Green Line Housing Program that started from COVID money that wasn't used, and that money was then reallocated to home affordability programs, which we were then able to do. Again, I was the first one to get that grant for our customer. This is something that we are, again, super comfortable with. We have a great track record of it, and we're just super proud of it. Okay, so making sure that this is digressing back to it being your leading strategy for a certain type of home buyer. What do I mean by that? If you have the credit and you have the cash flow and all you're missing is that collateral, which is your down payment and your closing costs. If that's all you're missing, it's so, how do I say, it's so possible to go with CalHFA, and it's so possible to go with GSFA. And it's easier to qualify for these things when you have the other two C's required, your credit and your cash flow. Now, if you have a lower credit, but you got the cash flow and you don't have the collateral, what we've come up across is when you have lower FICO scores, you're dealing with somebody who has debt. And this comes out to be a problem when you go to qualify them, because you'll see that their debt to income ratio on the back end goes further than 50%. We typically have hard lines right around that point, and dealing with automatic underwriting gets very fickle right around 50. We're right around a 640 FICO score or lower. It's not that it's impossible, but they need compensating factors to qualify, meaning higher payment and reserves in the accounts that reserves in their asset accounts. If they're getting a down payment assistance loan, we know that that's not possible, right? So then we can only count on how much money they make. And if it is significant enough, sometimes the system will accept it with lower FICO scores. But if it's lower than 640, you're going to have issues. You're going to have problems. It's not going to be something that is readily able to go for these people without the credit and collateral. But if they have the cash flow, I say look into it. Of course, we always take anyone's application who wants to apply. We're open to anybody. We'll give you just as much service as anyone else, but understand that it is harder for these borrowers to get qualified when they don't have the credit score to qualify for it. Now, when they do have the credit, 700 FICO score and above, and they do have the income for so, it is like a gift. It's like a gift to them. They are able to qualify for something they would never be able to qualify for without saving 40, 50, $60,000, right? Now that's something that we're able to do in the South Bay. It's something that we're able to do in Riverside. It's something we're able to do in Lancaster or any of these surrounding cities that are outside or into the suburban areas. And the reason why I bring those areas up is specifically because I've closed loans in those areas and they're towards the $400,000, $300,000 range in the outside areas. We also have them over here in in the South Bay of LA, which is 800, 750,000. That type of loan amount is what we can do when it comes to down payment assistance programs and what they could qualify for if they have a 700 FICO or larger. Let's see here. And we're going to go ahead and take another commercial break and explain it to you why we're here. Welcome to the Mortgage Master. This live is for mortgage loan professionals who feel stuck, burnt out, or know they're capable of more, but don't have real mentorship. Even if you struggle with inconsistent leads, not knowing how to confidently approach realtors, feeling capped at your current shop, or just closing loans without actually building a business, you're not alone. I see LOs every week asking the same questions. How do I grow consistently? Should I switch to the broker model? I'm in a bank. Should I switch to the broker model? Why am I busy but not profitable? How do I stand out when every LO sounds the same? Mortgage Master exists to solve that problem. Now, there are two ways to get mentorship from me. First is you can join my brokerage. For this, LOs who want full support, real pricing advantages, accountability, and to build a long-term team, whether you're experienced or eager to learn, we're actively hiring LOs who are coachable and hungry. Okay. If you're experienced, excellent. You're welcome to here. If you're inexperienced, we provide training, accountability. It's also something that I would like to explain in a sense that you're able to be remote as well as come into the office that you'll have 24/7 access to. So if you're looking for a remote and you're a self-starter and you just need a good shop to work at, we are here for you. If you're looking for more mentorship, you want to come into the office, you want to build funnels, you want to put more hooks out into the ocean so that way you can fish when the tide comes in and win, we're here for you. Second, you can join my mortgage mentorship program here on Skool. This is for LOs who want weekly mentorship, accountability, and real world strategy without switching companies yet. If you want to explore joining my brokerage, please comment broker. And if you want mentorship through Skool, please comment Skool. Either way, you don't have to build this alone. Follow the Mortgage Master. We're just getting started. Okay, so just to wrap this all up, I do this because most LOs were never properly taught this stuff. If you want more of these conversations, whether it's inside my brokerage or just through my Mortgage Master Mentorship community, I'm always open. There's no pressure. It's just growth. So please, if you feel if you're looking for any questions at all, loan programs or anything, please feel free to reach out to me, DM me anytime. I'm available Monday through Friday, 8:30 to 7 p.m. This has been a pleasure. Thank you so very much for everybody tuning in. I'm just really, really stoked to have gotten this out there in the world. This was the very first one, and it's only going to get better from here.